Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, September 23rd, 2019. I'll start out here with the daily charts. Not any big technical developments today, but there were some things that worth noting. We bounced off support today. I'll get to that in a second. I covered those charts on the site before the market opened today, but there's some important support levels to watch. And the common theme is, again, it's just a flat. This market's flattening out. SPY was up 1/10%. QQQ closed slightly down today, so another pretty much go nowhere day. But the common theme here, the theme that I want to point out, is one that remains. It's a market losing momentum. You guys know I like to use divergences a lot. It's a big part of my trading, looking at indicators in divergence. And what these are momentum indicators down here, the PPO, the RSI. And what they tell us is momentum has been waning. So, for example, pretty much since the last Fed cut, right here, when we peaked back in July at the July meeting, that's now been over 2 months ago, that's where the market topped. So we had a correction. We came all the way back up there, but we're back below there again in both SPY and QQQ. And the most recent high, as I mentioned, was a divergent high. There were a lot of technicals things. I'm not going to get too deep into that today. Everything was covered as recent as Friday. The break of the primary trend line off the December 24th lows in SPY. We've yet to break that comparable trend line in QQQ. I believe that's what's holding this market up. The market-leading tech stocks, which although they're the biggest component of the S&P 500, they're by far the largest, even a much larger weighting in the tech-heavy Nasdaq 100. So we're watching that. But again, to me, it's a story of a market that's losing momentum, and that's simply what these momentum indicators tell you. Here's 3 successive lower peaks as the market makes new highs here. In fact, it's even easier if you look at it on a weekly chart here. Let's go to QQQ. That's the king of the momentum sectors, if you will. And there it is. So that's what happens. So market during a strong advance, like right here, look at there's a strong advance for sure. You had the market going up. I missed one little divergence right there towards the end of it. So these are things I look for. Had a divergent high right there. You had a pretty healthy correction. Negative divergence there, correction. You had, at this point, instead of the indicators making lower highs, like they were there, you have indicators making higher highs. That's a healthy, strong advance. And you can see it lasted all the way up until that point where you put in right there, a little small divergent high. Nothing to go crazy about, but it did result in the biggest drop in over a year at that point. And so that's it. And then again, the market just continued to power up, but you can see there the momentum indicators telling you the momentum slowing by making lower highs. Those are the divergence lines, with prices making higher highs. And then finally, boom, big sharp drop. That was over a 20% drop in QQQ right there. The index itself fell a little less. The ETF fell more than NDX. But again, you push back up, just like recently. You had a divergent high, you had a sharp correction. You pushed up, and what happened is the divergences simply were extended at that point. That line should look like this. You extended there, put in another divergent high, and another big drop. But then, again, healthy advance. Indicators climbing, moving up, no divergence along the way until right here is where we started diverging. So that was a healthy advance, and this was your first divergent high, first correction. Instead of the indicators going on to make a new high, they put in a series of lower highs, and that's what's been going on here lately. And this is a weekly chart that I jumped out to. So you had another correction. All along, the prices continued to inch higher, but again, losing momentum in the process. We had a thrust up there, but again, we continued that divergence, and that's what's going on here right now. So again, it's just a market that's losing momentum. Doesn't mean that it can't break out from here and start to run. If you want to say it's consolidating, you can certainly say that. I mean, here's the thing. I've gone over this before. If you look at where we're at, and this is the tech-heavy QQQ. SPY, it's a little bit less, but if you look at QQQ and you go back all the way here, this goes back into August. You're right about where we were back then. We're about 1% above where we peaked out in August. And on SPY, you can go all the way back to the beginning of 2018 and measure that out. You can see the pop-up box on the left. You're about a little less than 4% above where we were back then. And from where we were back in August of 2018, we're about 1.26. So again, it's been a big drop and a big rip, but at the end of the day, in the market is just really. It's like, to me, I use the analogy of one of those super tankers in the ocean turning. When the economy or the stock market turns, it's usually a very slow turn. They don't turn on a dime like a speedboat. It takes a long time for those boats, those big super tankers, to make a turn, and that's what it appears here. But we'll see. Sometimes you had something similar happen in 2015, 2016, and the market broke out to new highs then. But again, it was a little bit different technical posture. Right now, we have those clear divergences intact, and at this point in time, other than using the PPO and RSI and other momentum indicators to look at the divergences, one thing I like to look for, and I've pointed out, is clean separation on the two, and then look for the bullish and bearish crossovers. In other words, when you're in a choppy kind of grinding market, you don't have clean separation between the lines. Here, I'll zoom in a little bit and you'll see what I'm talking about there. See, this is clean separation right there. And so you look for these high-level bearish PPO crossovers, like you had one there, you had one there, and you can see what happened afterwards. You get corrections after those crossovers. This one's a little bit sloppy there. You might not want to look at that. That one's about as clean as it gets right there. And so that's something else to watch. We don't have that crossover yet. You can always put up a PPO histogram, and that will show you when you get the crossover, when the lines cross below the zero line. So this will go from green to red once we cross the zero line. And again, you can see you want to look for it when you have these what I call hills, clean separation like this, clean separation, and then you get the bearish PPO crossover. But as I said in the video for members earlier today, sometimes you get them. Here was a big hill right there. You had a bearish PPO crossover, and it only gave you a little correction, and then we pushed back up. But you had another crossover here. So in other words, you whipped around for a little bit, but there was your sell signal. Now, what made that one different, and I know this chart's busy. Let me see if I can give it to you on a cleaner board. You know what? Let's just take all the lines away. Let's do that, and we'll look at it there. What made that one different is from the earlier one, we had a trend line that didn't break until right here. I had a couple trend lines drawn, and you know what? I have to turn those lines back on. Go back to that chart. Here we go. Yeah, there it is. So you can see the trend line. So that's one thing I look for is, again, PPO bullish and bearish crossovers alone. Over years back, I ran some, those programs where you can back test. You type in all types of signals, and it was a mixed bag. And so it's not in itself a consistent strategy, I believe, to go long and short on the bullish and bearish PPO crossovers. However, the takeaway and the value I find is when they align with chart patterns. For example, you had a bearish rising wedge there. You didn't have it right here. You had a very minor trend line that was forced in that breakdown, and you did get a little correction. It was tradable. But this bigger signal came right here, and it aligned with a breakdown of that trend line. And so right now what we have on SPY is you have the primary uptrend line off the lows on December 24th, which again has already been broken and just recently back tested. That back test of the trend line coincided with a rejection, another failed breakout to a new all-time highs. Nothing big yet because we turned down, but we did also roll over after the back test of the trend line and making that divergent high. And so we had a sell signal with the break of the minor trend line there, and again, so therefore, well, let's watch and see what happens if we start to get if we do get a bearish crossover there. And the same thing holds true right now in QQQ. There's your PPO. Any more downside, you can see the readings at 0.01. So any more downside, we're going to cross. Now this is more important because QQQ to me is the more important of the indexes. And there, I'll just go back here, take away all the trend lines, and park this PPO histogram, put it back over here, get it out of the way, and show you what I'm focused on. Again, the most important thing to me right now is this trend line off the lows on December 24th in the tech-heavy QQQ Nasdaq 100 index, as well as the tech sector XLK. We had a few, intraday breaks, and most of those were just they were stick saves. We managed to rally back up and close on that trend line there. So there's QQQ, and then the all-important tech sector. Like I said, this is by far the largest sector in both the S&P 500 and the Nasdaq 100. So That's what I'm getting at. All this stuff kind of ties in together. Momentum's been waning, a series of divergent highs. The tech-heavy QQQ and tech itself, unlike the S&P 500, has failed to make a new high. And again, remember, this is the Fed started cutting rates back here. And so the oomph, if you will, well, we know what happened the first time they cut. And then again, we had an additional cut this month, and yet nothing. No follow through to the market. So the buyers are not there. Now, look, the market is still within spitting distance of new all-time highs. We've had a few marginal breaks, but as I said, you guys know that I'm thinking we're going lower. That's what the charts are telling me. So I'm not going to spin it otherwise. But again, I'm not calling that a bull trap really, because it wasn't an impulsive, convincing breakout. I don't think that breakout last week in SPY sucked in a lot of new buyers, if you will. But then again, that's also the thing. This market's had a lot of opportunity to break out to new highs, and it hasn't yet. So take it for what it's worth. Either way, new highs are not far above for tech and QQQ and SPY, but nor are a break of these important trend lines just below. And it's these indicators that tell me I have very little fear, with swing short holdings that I've held now for, 6 weeks, since we rallied the first time to the top of that August trading range. That's when I reversed. I'd been short, then long off the bottom back here, and then this is XLK. Go back to QQQ. And again, I'm talking swing short positions, which are completely different from my active trading account. That I'm long short. But most of my focus has been, and I can tell you, all of my profits in the last couple months have been from gold, silver, platinum, treasury bonds, both long and short. That's where the big focus. And in fact, I haven't even had to have that much of a position. I initially took them as hedges. First going short the metals and treasury bonds when they had the divergences to hedge against those index shorts, and then more recently going long because the charts dictated it. And believe it or not, and I answered this question to somebody today who was very frustrated with the market. This market's going nowhere for the last couple months. The range has been, when you look at the broad market from back here, where was it, in early February, right here at this point, you can see we've been in a range from the beginning of February to right where we're at today. No, let's go all the way up to the highs, about 10-11%. And that's most of the year. Most of the gains were made on this initial pop there, which very few were probably got a hold of. We got bullish and long right here on right after the December 24th lows. Had some long trade ideas. Admittedly got out early on those. Unfortunately, it'd be nice to say I was able to hold all those to right here. But as an active swing trader, when the risk reward's not attractive, that's fine. My point being is this happened so fast that most investors capitulated, and most didn't want to buy in till up here. So again, so the point is, the gain so far this year, it has certainly been an up year. Right now, from the first of the year, the market is clearly positive. But if that's just picking starting points, going back and playing the game from here to here. And I just played that game right here from beginning of February up until there. But again, I was trying to make a point here that it's momentum waning. This is, almost the entire year has been in this trading range that measures about 11% from top to bottom. And again, even if you go back to last year, and that's best viewed on a weekly chart. And again, that's what all comes back to this. All comes back to a strong market that's still fresh in everybody's minds, but it's been becoming less strong, if you will, since it peaked back in January of 2018 early. And again, it's hardly up since then. It's had a lot of big moves in between, but this is telling me that the upside's most likely limited. All right, so you've heard me say that for months and months and months. So let's just get to the charts now and look at near-term levels that might determine where we're going. This is SPY. Very busy chart, I know, but here, I'll take off all the lines and just point out the most salient points on this chart. We have, as I mentioned recently, the high last week, new all-time high, intraday pop, very marginal new high, but it was still a divergent high. Let me try to get the right drawing tool here. And so we had negative divergence building, and that divergence has started to play out. We had divergent high 1 right there. There's your negative divergence continues to build. So we had that little blip, push up, a roughly equal but a marginal new high, and then a pretty impulsive selling since then. So those divergences have most certainly started to play out. The near-term trend since last Thursday's high is bearish, and you can see what looks like we formed today with the little kickback off the lows, what could be a bear flag continuation pattern right there. You have an impulsive move down, and we hit support. As I did the update this morning, we were at some pretty important support levels on the futures, which I'll get to in a second here. So if we happen to either gap down tomorrow or open flat and then start moving lower, we might get that. That would be the catalyst, certainly, if we do break down impulsively tomorrow from that flag. The catalyst for that move down that I've been looking for a while, at minimum come in and test the top of the August trading range. That's what we're looking at here. All these are the reactions, all the highs back in August, early September. Then we broke away, had a breakaway gap right there, broke above it, and unlike QQQ, which has already back tested the top of its trading range, SPY has yet to do so. So there's something to look out for tomorrow. And I can tell you from the look of this flag, if it doesn't happen tomorrow, if we happen to move higher or even sideways, the flag's not going to be very symmetrical, or at least not proportional, I should say, to the pattern, to that flagpole. So there's something we need to watch for tomorrow. Again, like any setup that's untriggered, it is only a potential setup. The sell signal or the trigger would come on a break below that, but then let's take it one step further and let's look at the futures. That's what I covered this morning. All right, NQ. I'm going to show you two different charts on the Nasdaq 100 futures. First one being this chart here. Both of these levels are the same. This is the big number on the Nasdaq 100 futures, about 77.92. Why? That's the top of the August trading range. You can see it with support right here with a reaction. We broke below, and every single advance back in the month of August into early September was capped there. There was our breakout, back tested once, twice, three, almost 4 or 5 times, and we're right above it right now. So that puts the NQs in a very precarious situation. So as I pointed out this morning, we were at or just above support, and so far that support held. So it was really a go nowhere day. In fact, then, as I said, the Qs closed down today, but again, I'm not going to say it's bullish, bearish. It's pretty much a flat day with some consolidation, but bigger picture is, as I pointed out last week, the Nasdaq 100 futures broke down below this trend line, went on a holding pattern before the FOMC announcement or the rate decision, but since there we've had nothing but downward, a downward bias, sideways to downward. So again, big level to watch right there, and obviously we haven't even tested the previous highs yet on the Nasdaq. So should we start to move higher, you can see the levels I have marked. Probably the biggest one would be that 79.78 resistance right there, and then after that you have those previous highs back here from what was that, late July, I believe. Okay, and this is the same security. These are also the Nasdaq 100 futures, but this is that potential head and shoulders topping pattern that I've been highlighting recently. So you have here, we'll make it very clear that you have the neckline. And like any pattern too, it's only a potential pattern pending a sell signal. So you have the left shoulder, you have a head, and you have a right shoulder so far. So everything it's fully mature now at this point, with just pending a sell signal. Now, as I said this morning in the video to members of the right side of the chart, there's that same 77.89 level. You can't see the whole trading range. It's to the left here, the August trading range. So to play it safe, should the neckline break, a couple things. Number one, you don't want just a little blip. We had a little blip low there today, but you want to see a solid impulsive move down there, especially if you can get a 60-minute close below. But with a more important, I put a much higher weighting on that top of the trading range from August and early September. Why? Because of all those reactions, multiple reactions. It's a much better watch level. I guarantee you that a lot more traders see that line and are watching that level than see this line that I have drawn here. So that's why it's more important. So therefore, we really need to take this out with conviction, 77.89 on NQ. And I think if I didn't cover ES, then I will right now. On ES, 29.79 is the level that needs to go. That's a pretty important level. Remember, ES is the S&P 500 contract for the futures, E-mini futures. But you can see so far that seems to be where ES has been finding support since the recent FOMC meeting, even before that, and since the breakdown too. Remember, we broke down just before the Fed meeting right there. Markets didn't really go anywhere because they were waiting to see what the Fed would do. But again, just very lackluster response since we got that rate cut. And it's kind of keep it simple. Markets in a trading range right here. And it's either going to break to the upside or downside. I still favor a downside break. That would be my preferred scenario at this time still. And again, you can't see it here. I'll zoom out a little bit. You can see that is there's your big August trading range in ES, which has not yet been tested. And I have sort of a zone here, if you will, but 29.39 to 29.45, that would be the top. So there it is. So if we break there, I can tell you if ES breaks that and does come down for a test of this trading range, it will have triggered the breakdown on the NQs. However, we may not hit the measured target, or at least not right away, because I would put pretty good odds that the buyers will step in at this level, at least on the initial tag, if we drop down to it from initial tag from above. So that's it. It's a very near-term and untriggered sell signal. I had a member of the site ask me today. He said, "Randy, hey, I know you've been, it's in your swing counts short for over a month now, and I have the same views, but I don't have any positions. I'm looking to get in. Would you recommend getting in right now?" I said no, I wouldn't if I didn't have anything, because we're right above support, as I just showed you on NQ and ES, as well as, of course, QQQ and SPY. And so Trading 101 says you either buy a pullback to support or you wait for a break of support, but it's not objective to go short just above support. So a little more downside, those levels I just showed you on NQ and ES should do the trick. And that is where, if as a swing trader trying to position for a much larger drop, I said what I would do then is take a starter position there and then add to that position if and only if, or if and as the bearish case continues to firm up. By that, what do I mean? Well, for example, one thing would be a break back down into the August trading range, solidly into it, not just a little dip down below, but a solid move back down within, as well as NQ, which we'd almost certainly have, because again, NQ is a lot closer to the top of its trading range. And then go back out to those weekly and monthly charts that I've covered recently, things like break in a weekly close below that uptrend line off the December 24th lows on QQQ and XLK that I showed you in the beginning of the video. There's things I'm looking for on the monthly chart, our longer term trend indicators. Most of those are still bullish, and we're still pending some pretty good sell signals on the monthly time frame, such as a monthly close below the 20-month exponential moving average, the primary uptrend lines on some of the indexes, so things like that. So in other words, it would be a maybe, let's say, 1/4, 1/4 position here. You get those near-term sell signals I'm talking about. We start getting into the trading range, maybe another third or quarter, and then finally, if we break down below the bottom of the August trading ranges, or really I think what'll do the trick on ES, even though that was technically the low right there, ES kind of stabilized right here about 28.20. So each of these are check marks for the longer term bearish case, and if we start to get these, even just on this 60-minute chart, we get down this far, it will almost certainly have taken us down below those trend lines on the weekly charts, the more significant longer term trend lines and moving averages, like I'm talking the 40-week moving average on SPY and QQQ. That's a big one as well I want to see taken out. And so that's how I think the best strategy, if you share that view. And if you don't, if you're bullish, I do these videos. I'm going to tell you my thoughts if I have a strong opinion. If I don't, I'll tell you that too. But But if you're bullish and you're right and I'm wrong, then what you want to do is buy these pullbacks to support. That is a great support level. If I thought the market had another 10, 15+% higher to go this year, if we get down here, I would be buying with both fists. Just like, you can buy a breakout to new highs if it's impulsive. So those are levels that bulls want to watch, breakouts to either new highs that you see some volume coming in, not just a little, wimpy failed breakout we had the other day, or you buy pullbacks to support. With stops somewhat below. I would be concerned if I was a bull and I was long and we fall much within this trading range and don't get back above it soon. But again, there's a lot of other levels to watch too, below there, as I just talked about. 200-day moving average, 40, which is the same as a 40-week moving average. Those trend lines off the lows from December 24th, things like that. And finally, just a quick update on the small caps. I'm gonna, every now and then I like to include that. IWM, you can look at this one of two ways, and I'm going to show you a potentially bullish scenario here. Well, both sides. We have this trend line here that comes in, and if you take it off the highs back in 2018 in IWM, come in here, you have a couple reactions there, another tag right there, and another failed attempt there. We had an intraday break, but if you look closely, those are just candlestick wicks, little shadows up on top. We closed down below, and when we were rejected on the attempt to take out that trend line. We also have the key 159.41 resistance level. That's why I've colored that blue. Lots of reaction. That was a failed breakout attempt, followed by a big correction, another failure there. So far, another failure. Could be more. Failure there. You get the picture. I've covered this before. Lots of levels there. That's why I have it standing out in blue. Now, I had earlier, a few weeks back, I had this trend line coming in this way, and I can really use either one. And the reason is you have the same highs right here. You have this reaction high. Come in, you almost catch that one. You catch a couple right there. Little failed breakout attempt right there. You can see popped intraday, fell back below it, and then finally we made an impulsive break above. So this is the glass half full. This may pan out. We have a pullback to both support. See that 154.65 line right there? It's a support line, pretty well defined, lots of reactions when you go back a ways, all the way back to here as a matter of fact. So you can look at it as a breakout and a back test of both the trend line and the 154.65 support. If that's the case, and I can tell you it's objective to go long there because of that, especially if you're thinking there's a lot more upside. And then again, you're still going to have to get through 159.41 or so, and we'll call it 159.50. And if so, maybe you get a breakout here. So there's a potentially bullish scenario, but like I said, we can also say it was a failure here, and as I showed you in the beginning, a lot of rejection. So do I have a strong opinion? No. But which one do I favor? Because I think there's more downside in equity markets, I'm leaning towards the downside scenario there where we come in. And of course, we did have, as I pointed out here, divergent low recently. But I'm leaning towards that one. But this is one I'll have to respect. And, I might be long RTY should that break out soon. I have no position right now in the small caps, but I'm watching this closely. Let me show you the futures as well. Here's another potential bullish setup on the futures 60-minute chart. So back here we had, and it was pointed out at the time, and I was long after that, divergent low right there in the RTY, and that was a catalyst for this big move up right there. Since then we had the couple of trend lines, but this being the more important of the two. This was your a well-defined trend line, a lot of reactions here on the 60-minute chart, broke down, and so far since then, so there was our sell signal, and we had a divergent high at the highs. This right here was the high in IWM, and since then we've been moving lower, as you can see, defined by this downtrend line. Here, let me zoom in a little bit, get a little tighter for you so you can see that one. All right, so we have a downtrend line to watch. And again, this could also trigger a buy signal for RTY, small cap futures. And we also have, I didn't draw that out very well, but you have positive divergence as well here on the 60-minute chart. So we don't have a buy signal, but we have a divergent low. We have small caps falling to minor support level, or support zone we'll call it. And now if they continue to drift lower, right now the near-term trend is bearish. There's your lines. The trend is simply defined as prices making a series of lower highs and lower lows. So if that continues, what you want to look for is watch this support here. It's a pretty big level right there, about 1528. So again, if we continue lower, we break this support zone, 1528, where support starts to come in. I don't have a whole lot of support before that. And then you could probably put a line underneath to say it's a support zone. So there it is. You can trade that as you want. I doubt that this is going to break out and play out for a big move if SPY and QQQ and NQ and ES break those levels that I just told you and they start moving lower. So that's something to watch as well. Let's just say you only trade small caps and you get a breakout here and it's impulsive and it looks good and you're rallying and you're up to this point, but then SPY and QQQ break down and ES and NQ, you might want to either tighten stops or just book profits there, because that breakout would most likely fail again if the large caps go down. So that's it. We'll wrap it up here. As I like to say, support is support until unless broken. So we tested those support levels at the lows today on ES and NQ. So we'll watch those levels for tomorrow. And if you only trade QQQ and SPY, same thing. You just want to watch for pretty much today's lows, and then a little bit below that, as I showed you, there was support a little bit below on QQQ, right about here. Maybe call it about 189.17 or so. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.